The rollout of vaccines should make 2021 a year of global economic recovery. Markets have already priced in a lot of good news, but more gains seem possible as company profits rebound and central banks remain on hold. Hi, my name is Andrew Pease and I'm the Global Head of Investment Strategy for Russell Investments. Welcome to our Global Market Outlook for 2021. 2020 has certainly been a memorable year and one that delivered a lot of surprises. The speed of the pandemic was clearly a negative surprise, but the size and effectiveness of the stimulus responses by central banks and governments was a positive surprise. Perhaps the biggest surprise is that global equities, as of early December, have gained around 12% since the beginning of the year, an outcome few would have predicted during the depths of market panic in March. We have a positive outlook for global economic growth and corporate earnings for 2021. The recession caused by the pandemic this year means that we are now in the early recovery phase of the cycle. This should deliver an extended period of low inflation, low interest rate growth. This early cycle environment usually favours equities over bonds. There are, of course, some near-term risks. Investor sentiment has become very optimistic following the vaccine announcements, and this makes markets vulnerable to any negative news. This news could include renewed lockdowns in Europe and North America as virus cases escalate during the winter, logistical difficulties in distributing the vaccine, and negative economic growth in early 2021 if government support measures are unwound too quickly. Geopolitics could also throw up negative surprises from China, Iran, or Russia as the new Biden administration takes power in the United States. Our cycle, value, and sentiment investment decision-making process scores global equities as expensive, with the very expensive US market offsetting better value elsewhere. We see sentiment as overbought and the cycle as supportive. Overbought sentiment has us slightly cautious on the near-term outlook, but we are more optimistic on the medium-term outlook, with the positive cycle outlook offsetting expensive valuation. A return to more normal economic conditions by the second half of the year should see the market rotate away from the technology and growth stocks that have been the best performers this year and towards the value and cyclical stocks that have been poor performers. Technology stocks have enjoyed tailwinds from higher earnings and lower discount rates during the coronavirus pandemic. These tailwinds should become headwinds once a vaccine is available and lockdowns have been eased. The post-vaccine recovery outlook should also help non-US markets outperform the United States. The S&P 500 is overweight the tech and healthcare stocks that dominate the growth factor, while the rest of the world has more of the financial and cyclical stocks that make up the value factor. Investors are likely to rotate towards the relatively cheaper value and non-US stocks that will benefit from the return to more normal economic activity. A risk for equity markets in 2021 is rising bond yields. We think that the improving global economy could see long-term bond yields rise by 25 to 50 basis points. Equity markets can often navigate rising bond yields if the reason is better prospects for economic growth, but a rise in excess of 50 basis points may provide a test. Technology stocks received a large boost to valuation from lower bond yields this year. The large tech stocks make up around 25% of the market capitalization of the S&P 500. These big tech stocks have accounted for almost all the gains in the S&P 500 so far this year. A bond market-led reversal in tech stocks could stall the overall market even if the remaining 75% of the S&P 500 makes post-pandemic gains. We don't think this will happen, but it is a risk worth watching. Let's turn to our asset class preferences. We prefer non-US equities over the S&P 500. The post-vaccine economic recovery should favour cheap cyclical and value stocks over expensive technology and growth stocks. The rest of the world is overweight cyclical and value stocks and underweight technology stocks relative to the United States. We like the value in emerging market equities. China's early exit from the lockdown and stimulus measures should benefit emerging markets more broadly, as will the recovery in global demand and a weaker US dollar. High yield and investment grade credit are slightly expensive but will be helped by the recovery in corporate profits and the decline in defaults. Bank loans and US dollar denominated emerging market debt, in our view, offer the best opportunities. Government bonds are expensive. Low inflation and dovish central banks should limit the rise in bond yields over the next year. Inflation-linked bonds offer good value with break-even inflation rates still well below the Fed's targeted rate of inflation. The US dollar should weaken into the global economic recovery given its counter-cyclical behaviour. The dollar typically gains during global downturns and declines in the recovery phase. The beneficiaries should be the economically sensitive commodity currencies. These are the Australian dollar, the New Zealand dollar, and the Canadian dollar. The euro and British sterling are undervalued. Both currencies should be helped by the post-vaccine recovery. The high level of investor optimism following the vaccine announcements is the main near-term risk. This means that any negative news, either in terms of the vaccine rollout or perhaps a rising infection count, could see markets give back some of their gains. Longer term, however, an extended period of low inflationary, low interest rate growth should allow equity markets to make more gains. Thanks for watching. Have a great holiday period, stay safe, and we'll talk to you again soon.